Hello, everyone. Thank you for connecting to this event. I will try to give you a very brief, generic, simple introduction to the topic. So the title already of the presentation of the introduction says quite a few things. It says Libor no more, like a lie, because the reason why Libors are disappearing are because there was some cheating about their real value in the past. No more because they are disappearing. I just said that already. And you see this Englishman with the long nose. Why? Because Libor is the London interbank offered rate, as the vast majority of you know. And even if it's US dollar Libor or yen Libor, it was administered out of London. With that, I think I can go to my first slide, which explains how the Libor panel works up to this day, and what in this functioning of the Libor panel has caused problems and is leading to Libors disappearing. So on that slide number 3, you can see on the left-hand side what is a Libor panel. A Libor panel is a group of banks that are contributing values that are used to give the fixing of Libor. So on a given day, this bank would be asked by the administrator of the Libor, well, today, at what rate do you lend to each other for the 1 month, the 3 months, the 6 months? And then there would be some kind of exclusion of the extreme values and averaging of the remaining values, and that would give the Libor fixing. And what was the problem with that? Well, the problem is that it was people giving values. It was not an average of what was happening in the market. It was not based on the real executed transactions. And so after a while, some people figured out that they could actually give a value that was beneficial to them or beneficial to their good friends. That's called rigging the market. That's, of course, totally forbidden. And so you can see on the right-hand side, there were like prosecutions after that in courts of laws, some exchanges between traders at the time, like you know, dude, give me that rate, it would be really cool. Oh, okay, I'll put it low for you, and so on and so forth. And that in itself was sufficient to cause enormous problems and bring a reform that will end all Libors. So that said, on the next page, I put a brief view of all the fines that have been levied. So BNP Paribas was not part of the banks that were you know, fined for manipulating rates, but a number of banks were found to have manipulated rates. And at the time, the biggest amounts of fines was imposed to Deutsche Bank, and that even caused the CEO, the chief executive of Deutsche Bank, Andrew Jain, to resign from his role. That's how serious it went. Yeah, that's just indicative with, yeah, that said, I'm trying to keep everything quite short. That brought on a reform after that, which is a reform by the Financial Stability Board, which is the instance in which all regulators sit. So maybe if we look at the next slides, I'm not going to say more about the fines, but the next slide explains that the Financial Stability Board has been commissioned by the G20 to reform into Libors. And so they first established a group that was tasked with assessing the problems, taking what they call a fundamental review and saying what is needed to improve things or fix things. The second thing that happened is there were a lot of regulations, codes of conduct, laws, principles that were defined regarding what should be done with benchmarks, what shouldn't be done with benchmarks, and what everyone has to be committing to. And the most probably important of those, if there's one, is the IOSCO principles that explain that a benchmark must be actually based on sufficient amount of data and must be representative of its underlying markets. And if you remember two things about benchmarks, about why they disappear or why they can stay, mostly it's about this. They must be based on, as much as possible, underlying data, real transactions data if possible, or firm quotes, and representative of the underlying market. And then after all these regulations, there were a lot of work done by groups chaired by central banks and the private sector to establish in the various jurisdictions, because there's a USD LIBOR, yen LIBOR, as you know, like Swiss franc LIBOR, etc. So in each jurisdiction, the central bank chaired a working group with all the private sector to define how we could create new rates to replace LIBORs, and these working groups publish recommendations on how to use these rates. So that's, and with that, very quickly, these are the rates that have been created. But in the UK, Sonia, they were very shrewd. They didn't create it. They just reformed Sonia to make it better, and they kept it. But in other jurisdictions, there were rates that were created to replace LIBORs. And what you have to bear in mind about these rates is two things. One, they can differ in nature. Some of them are secured. They're based on the repo market, like for the Swiss franc and US dollar, and others are unsecured. So based on the same kind of a wholesale market as the LIBORs were. And the second thing is these are only overnight rates. So they only come with an overnight point. They have no term structure, they have no credit sensitivity, and they're not enough to replace LIBOR. What we have to do once we have that very simple building block of the overnight rates is build from that to create rates that allow to replace LIBORs. And LIBORs being used in different ways. There are different ways of using these rates. Compounding, building a term structure, making them credit sensitive, etc. And possibly to my last point, what is good to know about the planning of replacing LIBORs is there are two main dates for replacing LIBORs. One is the 31st of December this year, so it's coming very fast. And on the 31st of December, all the LIBORs except US dollar LIBOR will disappear, and two minor fixings of US dollar LIBOR 2. And the second date to remember is the 30th of June 2023, where all the main LIBOR tenors will disappear. And with that, I am done with my introduction.
Thank you very much, David. So I will stop this screen sharing so that Marc Henrard can share instead.
I think it's Claudio who goes first. But
sorry, it's Claudio actually.
Can you hear?
Yes, very well.
There you go. Is this working? All right, very good. Yeah, so I mean, this is a huge problem nowadays because, as Stefan was recalling, I mean, the sheer nominal exposure in LIBOR is humongous. And it's big because over the last 50 years, LIBOR became the pivotal center around which the entire banking system is revolving. Today, I will tell you about an article that I wrote on this topic with my colleague Stefano Iabichino, addressing the particular issue of how to risk manage the LIBOR transition. Not just how to replace it, but how to avoid or prevent or price the resulting risk. Just to summarize, as you all know, I mean, banks are in the business of procuring capital from investors and allocating capital to creditors. In that process, they transform risk factors, they transform cash flow streams and payoffs. And they do that by replication. Most risk factors can be replicated with various techniques, but there is one particular risk factor that is intrinsically impossible to replicate, which is the funding spread of the bank itself. The bank cannot just freely trade its own credit. And as a consequence, Libor was introduced precisely to facilitate this type of risk management. But Libor was an imperfect solution. It doesn't meet all the requirements that one would possibly desire. Nevertheless, it was a good step in the right direction. But more to the point, when we want to risk manage rates, there are 4 priorities, 4 angles that we can pursue. One is to look at risk-free rates. I mean, there was a mention by David of the overnight rate, which is the basis of Esther and SOFR and SONIA. That's what I call a risk-free rate. Risk-free rates are largely visible and replicable. But that's not the only angle we have. Another angle is to look at funding spreads on a market-wide basis, meaning taking an average over market participants, over the banks in the financial system, of their funding cost. And for that particular index, Libor was very well designed to provide a match. And since it became highly traded, there was a way to turn that particular risk factor into a hedgeable and replicable risk. A third priority is instead to risk manage entity-specific funding costs, which are separate from the market averages. So they are the specific cost of funding of one particular bank, which may be either higher or lower than the market average. That particular basis is very difficult to risk manage in any way, because, as I mentioned, banks are not intrinsically able to trade their own creditworthiness. And fourthly, there's a time direction into this. I mean, typically when you structure a Libor swap, the Libor tenor matches the Libor frequency of the floating leg. And you typically do not have much longer tenors than the frequency involved, unless you go to some exotic products like CMS spreads or of that sort. But Libor was not designed to match anything different from the frequency itself. But ideally, what we would like is not to have to go back from this situation where we have an imperfect solution where we can address 1 and 2, but 3 and 4 are difficult to handle. What we would like is a way to address all 4, since we are at it at transitioning away from Libor. And so this is the metric by which I think we should assess the whatever fallback strategy is proposed. Now, in addition to these 4 risk management priorities, there are other priorities. As David was mentioning, there is legal risk intrinsic in an index which is based on a thinly traded asset. Secondly, as I'm sure Marco will tell us more later, there are lots of complexities when refactoring payoffs that were conceived for Libor into payoffs that instead reference something different. So we would like to have a solution which is simple and general, but which is also legally unassailable and not manipulatable. Now, from the point of view of hedging, well, if we want to have entity-specific hedging, or even market-specific hedging, I mean, the only way you can hedge funding risk is to do it not by delta hedging, but by really embedding this immunization strategy within the structures themselves. I mean, that's the whole idea of LIBOR. You know, you index a LIBOR, so you're automatically, in a way, hedged with respect to market-wide funding risk. But even on an entity-specific basis, the strategy would have to go down this path as opposed to having something you can delta hedge. Because if you start delta hedging the credit of banks, what you end up doing, since you cannot short yourself, is to short the credit of other peers. And that's really not something that is, you know, to be encouraged. I mean, it's would come at odds with financial stability considerations. Furthermore, I mean, another concern here is model risk. I mean, if we look at overnight rates, obviously there is no model risk, and we can see them. But if we start looking at terms, if we start looking at swap rates, if we start looking at derivatives, obviously there is going to be model risk because we have to do forward-looking calculations. And as we go through this exercise, we would have to have a strategy to, in a way, offset automatically model risk. And finally, if we have to make regulators happy about whatever proposal we come up with, we have to argue that whatever we do will enhance and improve financial stability, not come to the detriment of it. Now, the first proposal for the LIBOR transition was just simply around the SOFR type of fallback strategy. So you just have basically SOFR plus a fixed. Without the credit adjustments. Credit adjustments have been proposed later because of the industry reaction to this. But you know, if we just look at SOFR, the reason why the industry wasn't particularly happy about it was that basically SOFR is a step back in terms of the ability and the toolbox to address the 4 priorities of risk management that I listed. Basically, banks would have to accept the full impact of funding risk on their balance sheet. And that implies that they have to recognize the cost of capital to offset that risk, which will then have to be captured by a cost of capital adjustment that ends up on the fixed side of, on the fixed rate of a swap, or on the fixed spread that you would add to a loan. And that's an inefficiency. I mean, that's a way to basically tax the market, to transfer wealth to the balance sheet of banks because they have to do the risk management. And it's really an inefficiency that we would like to avoid. Furthermore, there is obviously liquidity risk, which can have systemic implications in situations of crisis. Funding risk is very much tied up with liquidity risk. Liquidity risk is not just the ability of not having the cash, but of having a too expensive access to borrowing. So it's really funding risk. But the basic, I mean, all of these considerations at the end, if you look at them, can all be phrased in terms of wealth transfers. Embedding a cost in a margin is a wealth transfer. Having risk that can cause losses to banks is a wealth transfer. Having legal risk that causes gains to banks so that they can be sued by disgruntled client is a wealth transfer. So what we would really like to do is to avoid these wealth transfers. And the solution of going down the SOFR route is really not very satisfying for it. As an improvement, people started looking at credit risk adjustments over it. There are several proposals around. I think we counted as many as 25 across all currencies. In the particular case of the dollar, the leading proposals are by ICE, the exchange that now is managing LIBOR, IHS Market, Bloomberg. Duffy came up with a proposal as well. All of these proposals are all based on secondary issuance of bank debt. The AXA proposal is distinct because it's an across the curve type of proposal that looks at all terms, while the other ones are focused on the short end of the curve. But all of these proposals suffer of a fine-tuning problem. I mean, in the market that is worth 200 trillion only for the dollar, a 1 basis point impact will be a substantial fraction of 20 billion. And that's a lot of money. So if we want to have a solution where there is no ambiguity on how we fall back, we would require fine tuning across all the various proposals to a precision that is less than 1 per mil of a basis point. Otherwise, speculators will work on it, and they will trigger and they will leverage up their positions to exploit wealth transfers that can be truly massive. The proposal Stefano and I came up with is aimed at tackling the wealth transfer problem head on. And there's two sides to it. One is entity specific and the other is based on a market index. On the entity specific side, what we are proposing to you is to use at the group level a technique that is typically deployed only at the level of the OTC book, and which revolves around managing funding risk reserves. I mean, this is something that is done in the case of OTC derivatives, and is done with a framework that is typically referred to as FVA, which means funding valuation adjustment. Basically, the FVA is an amount that you exchange with the client in such a way that the client can sustain the cost of funding for the bank. It's a way to transfer the cost of funding to the client. The idea here is to have this strategy apply also for the banking book and be encapsulated in such a way that not only you transfer the actual cost of funding to the final maturity, but you also transfer the risk of funding. So instead of having one single exchange at inception, as you would do in traditional swap trading for unsecured swaps, you would have a sequence of exchanges, periodic sequence of exchanges, where the counterparty would pay an amount that depends on the current funding cost of the bank at that point in time, and its extrapolation in projection in the future. So these FVA resets that I'm mentioning here are a stream of cash flows which are exchanged with the counterparties, and the counterparties both on the loan side that have the cash asset and the counterparties on the swap transactions. These reserves, according to our proposal, would have to be rigorously no profit, and so we propose that the reserves are captured in a special purpose vehicle that is rigorously incorporated on a no profit basis, and to which the bank can transfer the realized cost of funding by the Treasury. Now, to make this work, you will need to manage FVA reserves. So at any point in time, you have to project out your requirements in terms of future funding and come up with a number that you pass on to the client to keep it at equilibrium. Now, the way this is done is discussed in a series of articles, including Stefan as a co-author. The challenge here is when you project out your cost of funding is that you have to do this calculation accounting for the total collateral allocation in the future that is implied by the book at the entity level. So you have to look at the book of the whole bank, look at the whole collateral requirement. You have to account for the benefit of rehypothecation of fungible collateral, I mean just cash across the entire book. And you also have to account for the fungible nature of risk capital and reserve capital, which itself, although it's risk capital itself, can also be used as collateral. And that implies that an accurate calculation also has to project out cost of capital in the future. So this is the long formula that we discussed in these articles where Stefan again is a co-author. We have a whole series, but this particular one appeared on Risk in 2016. Now, having an accurate calculation for capital and funding requirements in the future is essential to make this work. And so we believe this formula that I just stated is really the central point. We should really try to implement this one. The alternative that is implemented routinely in OTC trading is slightly different. It's not as accurate as what we think is required here. And it differs in two basic ways. So firstly, it's a counterparty by counterparty approach that is taken from basically a CVA type of approach. And secondly, it doesn't account for the benefit of re-hypothecating across counterparties. Thirdly, there is nothing like a capital projection. So at the end, the numbers you come up with are different, inaccurate, and typically tend to be too large in terms of both the capital impact, the capital requirements, and the P&L impact. So this methodology has to be upgraded in order to be usable in the LIBOR context on a rigorous not-for-profit, not-for-gain basis. But nevertheless, this can be done, and the side benefit of this type of upgrade is that there would be a sizable capital relief even in the OTC book, where the old methodology is still used, and there will be even a P&L impact because, as I said, the established methodology that is based on a counterparty by counterparty analysis is very conservative, very wasteful. It doesn't account for these two major benefits, rehypothecation and fungible use of risk capital. And so there would be immediate benefits if one goes down this path, even in that particular case. But the second step there is that this would not only apply to OTC derivatives, this also has the potential to apply to loans, to bonds, to everything that you may have in the banking book. Now, the benefits of this approach is that, are manifold. Firstly, you address all the priorities, all the 4 priorities in rates risk management, because not only you can cook an index out of FVA resets that you may call LIBOR, but which now is going to be transaction based. But you can also have a specific strategy to offset the funding risk at the entity level accurately, and so all the priorities that you would want to meet are met, even more efficiently than LIBOR, because LIBOR is only a market average. So LIBOR does imply by itself wealth transfers. This way, we would just offset them from the ground up. Model risk is offset by the SPV construction, because when the SPV is overcapitalized, it will have to release reserves. So when the SPV is undercapitalized, it will have to ask for more. So by keeping the reserve level at equilibrium, model risk is offset to some extent, as long as you're not too way off to start with. All payoff structures that are handled this way could be handled within the exact same principle. If you have 4 different or 25 different fallback strategies with lots of different options for one particular exotic derivative, well, of course, you have indeterminacy. But if then on top of that, you overlay an FVA reset and you force funding risk to be transferred on a not-for-profit basis, simply by doing that extra overlaying on FVA resets, you are washing out the differences between all fallback options. So if you have just consider a fallback to SOFR, pure SOFR, or a fallback to SOFR plus a credit index, at the end, if you overlay on top of that of Fieri sets, the result is the same. Another benefit of this is that regulators seem to like it because there is a self-filling mechanism in place. If you base your index construction on entity-specific rates, and these rates are computed in a way to exactly reflect the cost of funding of the bank, what happens is that if a bank is in distress, its own rate will go up. As a consequence, the clients will have to pay a higher floater to the bank. This will create an incentive by the clients to novate. If they do novate, the bank will deleverage automatically, and they will do so at the profit because they would be, they would be able to close the deal at the market level that implies the profit. So in a situation of distress, there is automatic deleveraging and automatic profits that benefit the capital of the bank in distress. Of course, the bank will become smaller, but its probability of default will be greatly reduced. So this is what basically our proposal is about. More details, as I mentioned, are in the paper, but basically as a conclusion and to wrap it up, Libor's dismissal is a step back in terms of risk management, but we think it's also an opportunity to rethink the way banking is organized in such a way to actually make a step forward. And instead of amplifying liquidity risk or GWWR or capital requirements and all that, we can make a step forward and move towards a situation where we can accurately hedge and replicate funding costs by transferring them to clients and into the system, since banks cannot replicate them intrinsically. And this opportunity definitely is worthwhile catching. This will obviously trigger a rethink in terms of the way collateral is managed, even in the OTC space, although the proposition is motivated by OTC practices. It will involve improvement in the way we handle our capital, because to manage collateral, we will have to learn how to do capital projections, which is technically challenging, but totally possible, and would definitely take us a big step ahead. And it would take us in a situation where ultimately the fractional reserve system and organization of modern banking will become more stable, precisely because of the self-healing mechanisms. Once funding risk is totally transferred into the market and banks don't have to sustain it, then the better banks will be more profitable. The banks in distress will become smaller, but the probability of default and the probability of systemic crisis will be far lower in this respect, as long as at least the liquidity risk is concerned. So that's my take on this.
Thank you very much, Claudio, for this very inspiring talk. So as I said, we will take the questions in the end. So please, the audience, feel free to chat your questions as we go, and we will recollect in the end. So please, Mark.
Yep. On my presentation, I guess you can see the screens now.
Yes, very well.
Yeah. I would look at in some sense, the other extremity of this transition, not why we have Libor, but what will happen when Libor disappears. So that's what is called Libor fallback. But before going to the description, let me start by what is happening today if we have an instrument linked to Libor. So I have in mind a plain vanilla swap. it pays LIBOR, but what happens if LIBOR does not exist anymore? So today, if you look at your contract, and that's the case at least up to the end, or up to next week, it says something like, if LIBOR is not published, then you have to ask to a certain number of banks some quotation to replace this LIBOR. Obviously, if LIBOR does not exist in this well-managed governance, you cannot expect banks to give you a rate when you call them. If you look at the cleared market, so not bilateral, but at the clearinghouse, if you look at what is happening if LIBOR is not published, it says that at its sole discretion, the CCP will decide what the rate is. So in both cases, the end user does not know what is happening. So let me put that in a simple equation. LIBOR is LIBOR, at least we believe it is. That's the payment, L for LIBOR. What is the value today of that? We have learned in the last 50 years that the value of one of those payoff is the expectation of the discounted payoff. So nothing special there. But today, when we look at this LIBOR, we have question, does the fixing of my LIBOR, is it before the discontinuation? If yes, then you get LIBOR, no problem. But if the fixing is after the discontinuation, what do you get? And the reality today is that you don't know what you have. The question mark here in this formula is not a typo, it is what we have today. Today, as I said, it's up to next week. What will happen next week? So today here, as David mentioned, the expectation is that LIBOR will stop to exist in January 22, July 23, depending on the currency, and that will be announced very soon, my expectation, in the coming months. The exact date and the definitive date will be announced. But what I'm interested in is the LIBOR. Suppose you have a fixing which is after the discontinuation date, and you were hoping to receive LIBOR, but LIBOR does not exist. So what do you get? And the proposal, more than the proposal, because it is now in the wording of the ISDA master agreement, and it will take effect next week, is to replace it by the sum of two numbers, a spread, and I will not discuss the spread here. There are a lot of things to say, but I will focus on the other one, on the floating rate. So floating rate, meaning a rate which is changing for each fixing. So what is the proposal for that? And that is, there were several possibilities, but the one that is being selected by ISDA through consultation is the following, is to replace this one rate, one LIBOR rate, by a composition of overnights, those risk-free rates that we have mentioned before. And a composition is you take notional plus interest, and you do that for every night for a certain period, and you pay the interest and not the notional. So you have something like that. Good. Now, the question is which period? For LIBOR, you have one fixing, one LIBOR period. What is happening with the overnight? The idea is to take the LIBOR period, decompose it in overnights, compute up to the end, and at the end, pay somewhere here that amount. So when it is explained like that, it looks very good, very easy, but there are a lot of buts, which is, first I say you pay here. In the very best case, you know on that date, and you have to pay the same day. But that's the very best case. What can happen? For example, if you have a FRA, forward rate agreement, is that the payment take place not here at the end, but at the beginning. So you have to pay at the beginning of a 3-month period a number that you will know only at the end. That's not very good, but even for some plain, or for most of the plain vanilla swaps, because of not good business day, weekends, holidays, this payment date may actually be 1 day before the last fixing. So let's go into the detail of what is proposed. For that, I've put 2 lines. The first line is OIS, plain vanilla OIS, overnight index swap, as they are traded today. So composition, and you pay later. You pay T+2 in most currencies, so in all currencies except sterling. So the detailed proposal by ISDA is to take this period, which was the Libor period, go back by 2 days, T-2, start the composition there for the Libor period, let's say 3 months, and compose on that period. Which looks better, you have this T-2, but suppose this is a Monday, go back 3 months, go back 2 days, go forward 3 months. This is Saturday. Saturday close, go to Sunday close, go to Monday. Again, you pay on the same date as the fixing. There is a second layer of workaround. You have to go back as long as you need to make sure that you know the fixing at least 2 days before the payment. So it's getting quite complex. Does this have an impact? And that's what I want to show. The answer is yes. There is something hidden there that is creating real problems. For that, I start with an OIS. So overnight index swap, plain vanilla as traded today. And I take the starting date somewhere in 22 after the discontinuation. And I take a swap forward starting with a tenor of 2 years. And what I will put in the graph is the PV01, the present value of 1 basis point. To make the thing simple, my swaps have a notional of 10,000. So 1 basis point is 1. The risk here is the risk in 1 year time. So this is 22, so in 1 year time. So a risk of 1 year, 1 basis point. And a risk at the end, 1 plus 2, that's 3. So the interest rate risk is $3 per basis point at the end. I've put also an OIS with quarterly payment. That's not the standard, but I've put quarterly payment to match to my Libor fallback in the next slide. Obviously, in an OIS, the end of one coupon is the start of the other one, so you see nothing. So there is no risk left. So let's take the same dates, same starting and same end date, and apply the Libor fallback. This is the picture. Why? Because of all those changing and all those trying to fit into a Libor instrument, something which was, as Claudio said, not planned to be there, this overnight, you have to adjust each period in a different way. In this case, my first period finished there, the second one start there. There is an overlap of 3 days. Second one finish there, third one start there. There is a gap, a missing 4 days. And that's what you see here. This is overlap, this is gap. Maybe you don't see it exactly, but there is a small difference in date between this one and this one, a couple of days. But it's appearing in different places. Now you may tell me, oh, but you took the worst example possible. So to prove that I am in good faith, what I will do in the next slide is do the same thing for every day in the year. So I will take 250 swaps, one for each good business day of the year. So the first one is the same as before, starting in 1 year time and finishing 2 years later. And then every day, I add a new swap with also a maturity of 2 years. So this was 1. Now this is 2, 1 year plus 1 year. Notice that the scale has changed. I will explain in the next slide why I needed to change it. Now the end, this is 3. Already there you see something you may not have expected, is that they are not all at the same level, but in some days, like here, you see a larger risk. This is because the end date is on a weekend. So you have 2 swaps or 3 swaps, the one of the Saturday, the one of the Sunday end time, and the one of the Monday at the same place. So that's the normal one finishing on the same day. This is the one with 2 on the same day, 3, and even 4. That's probably Easter. Now I apply the same on my fallback. That's the picture. Why? Because all of those changes, those going back, going forward, and so on, will apply on all the swaps. You look at it like a random change, but they are not random. They are systemic. Weekends are the same for everybody. Holidays, months have the same number of days, 28, 30, 31. Leap year, which are important for this problem, are the same for everybody. So what you see is accumulation of those adjustments in some places. And there you can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In some places, you have 10 of those swap, those coupons coming in the same place. Even if I've done 1 trade a day, for some reason that I cannot explain directly, but if I was looking at the calendar, I may find a good explanation. Again, maybe Easter. On that date, there is an accumulation of risk. That accumulation of risk is compensated somewhere else by an accumulation in the opposite direction. Remember, all my swaps are all in the same direction. Let's say I'm long all the swaps, as you can see in the background in the blue side there, but with the fallback, it goes in all directions. Now, this is a report, a graph that I've done with daily PVO1, daily risk, but obviously that's not what a bank is using. A bank is using a different report on the trading desk, something like what is on the screen, which is also PVO1, but bucketed. 1 year, 2 years, 3 years, 4 years, not every day. So here are 2, the blue in the background plus the red in the foreground. I've done the same. The red side, the blue side. What you see with a normal tool in a bank, you see nothing. All those risks are hidden because they are somewhere where we are not used to look at risk. It is this specific date where something strange is happening, not because of economical reality, but because of the way this fallback was designed. And obviously, we have noticed that. I've been mentioning those issues for a long time, and some kind of breaking news in the quantitative finance sense, so from the last months, not from the last 2 hours. Now CCPs, so clearinghouses, where 90% of the swap are administered, are cleared, have announced in some way, this is not yet official, it's some kind of, we think we will do that, maybe let's discuss it, but they have both CME and LCH announced publicly that they will replace, not use the fallback, but replace the old Libor swap by standard, so vanilla OIS. If I go to this screen, the official fallback mechanism is the red risk, but the CCPs have announced that they will look at the blue one, ignore all those mechanisms, and go to something more direct, more simple. So, and I'm coming to my conclusion with that, which is there was a mechanism which has been designed by ISDA Bloomberg over the last almost 3 years. It took some time because all the issue I've mentioned, it is not trivial to replace a term rate by overnight. Composition we are familiar with, but shoehorning into an existing trade a new mechanism is not easy. The mechanism, which to my opinion is ill-designed, is creating those gaps and overlaps. Those are not random, they are systemic. They will be the same for all the banks, for all the trades and so on. And they cannot be hedged. If you have a risk, as we saw in the graph, which is 10 times bigger than your trades for one day, and the next day or the next week 10 times in the opposite direction, you cannot create 10 billion swap for 3 days in one direction, for 2 days in the other direction. All the standard product, being OTC or future, will never allow you to manage this risk. And the one which is relatively new in the last weeks is that the CCP planned or are planning, are in discussion of not using it. All the graphs that I've presented were only for the plain vanilla most liquid interest rate swaps. If you look at other instruments, caps and floors, Libor in arrears, range accruals, CMS, and so on, then the things are getting even worse. But the most important thing is plain vanilla swaps. That's where we have more notional, where it is most used by the end user. And that's what we see. This mechanism is not very good, and it contains a lot of hidden risk just on the market risk side. Again, we have to discuss the transfer of value and the spread at another time, but just on the resulting market risk, that is something which is not very good in respect to other methodology. And with that, I will finish this introduction or example of one of the things that can not be so good with this fallback.
Thank you very much, Marc, for this very clear demonstration. I suggest, Ernst, if you could share your presentation, please. It's now your turn.
Okay.
Perfect.
Did you get it?
We see you. We cannot see your slides. We see yourself.
Okay. I have no button to push that my screen is shared. Wait a minute. I go back to that.
At the bottom, there is a green share screen, no? At the bottom of the Zoom window.
The green one. Okay. Okay.
Would you like me to share your slides if you want?
Yeah, I pushed the green button, but I get something completely different.
Oh, okay. Let's see what happens if I do it and if I can.
No, let's see.
It seems I can do it for you, so I can open your file and turn the pages. That's okay for you.
Okay, So thank you. That makes it more difficult when you have to push the button. Now, at the beginning, in David's talk, he said very bad things about Libor. He was concentrating on the scandal. Now I want to say a few good things about Libor. First of all, it is an accepted index for 35 years. 86 is the official start, and the volume which is traded based on Libor was mentioned. The number is enormous, but one has to say that by its very construction, there is a conflict of interest. The people who run big portfolios, they are the ones who are asked, at what rate could you borrow funds were you to do so? And this is, of course, a temptation then to look at your own portfolio. Of course, theoretically, you could have Chinese walls in the bank and you say, okay, those people who report do not have any contact to the management of these portfolios, but that's not the reality. Nevertheless, personally, I'm very surprised that the change which we will see now took more than 10 years. The discussion about the scandal started in 2008. And this says something. Apparently, the market was not that unhappy with Libor. Nevertheless, now we will see the change. Could we go to the next one? Everybody has seen this picture. I mean, it's based on Euribor, which is a bit different case than Libor, but the qualitative features are the same. For most of the time until 2007, the Libor was considered to be risk-free, essentially not dependent on the tenor, because this panel of banks which reported the quotes, that panel was renewable in the sense that if one of the banks was no longer to be considered a decent candidate, could be replaced. Now in 2007, in end of July, beginning of August, the markets realized that there is really substantial risk in this market. And you all know what happened a year later, on September 15th. The proof was given by the collapse of Lehman Brothers. Nevertheless, these spreads which we see here did not disappear, and this is why the risk did not evaporate. And even with the new rate which we will have now, this overnight rate, it will be clear that this risk will not disappear. And as a consequence, one has to find something to replace this risk. Can we go to the next? Here is a different picture. We like to think in discount curves. And of course, now we have this negative rate. So the discount curve increases first, but the spreads show the risk very clearly. And this will no longer be the case with the overnight rates. This is the overnight rates, the red one, 1 year, 1 month, 3 months, 6 months, and 12 months curve. And of course, if you go to the next slide, you can, of course, show that the rates have the same pattern in reversed order. Can we go further? So what we observe with the discontinuation of Libor is certainly a loss of information. The cost of funding, which is represented by these spreads, is no longer an issue. A full term structure will be transformed into just one rate, actually the shortest rate. The short rate, as we know, is under the influence of the central banks, very direct influence of the central banks. The forward-looking technology, which we had so far, will be transformed into a backward-looking technology. Again, very fundamental change. The dynamics of the spreads is definitively independent of the dynamics of the risk-free rate, and this creates an overnight base. The overnight base creates a systemic risk in the system. What we have to consider in the future is this composition of floating rates. I'm essentially looking here at a loan. Of course, there are many other instruments in the market which have to be adapted in a similar way. We have a new basis, that is the overnight rate, which is compounded over a certain period, maybe the last 30 days. Then we need a systemic spread, which is currently included in the various LIBOR rates. And then you have to add, of course, a borrower-specific spread. That is your expertise in the bank, which includes, in particular, the credit standing of your client. Now, the first component is set in the meanwhile. That should not be discussed further. Also, the last component, that's your expertise, is not changed. What is the critical thing is the component in the middle, the systemic risk. Can we go further? What should it do? It should allow to hedge the cost of funding on a systemic level, at least on a systemic level. It should be robust and transparent. By transparent, I mean those parties who are interested should have access to the data to see how this rate is computed. It should comply to regulatory requirements. We have on the EU level, for example, clear requirements what such an index, if it is transformed into an index, should be. Now, if the systemic spread is still tenor dependent, is not clear. Maybe it's sufficient to look into an index across tenors because the funding habits of the banks have changed. They typically have now a mix of funding horizons. That means an index might do it. Now, an example was mentioned by Claudio. This is this AXI, across a curve credit spread index. It's a weighted average spread across maturity buckets. The paper is by Daryl Duffy, Antje Berndt, and Yichu Zhu, if you are interested. But it's only one of the examples which is discussed currently. Definitively, it should be based on a deep pool of market transactions. And if such an index would become popular, if people would trust in it, it would certainly spawn an active market for derivatives and thus offer additional hedging possibilities. Now, what Claudio presented is a different solution, namely one which is known under funding value adjustment. It's a trade-by-trade approach, which has, at first view, certainly positive aspects. The technology is developed in the OTC market. It provides a very precise hedge of funding risk. He even proposes not just an upfront payment, but periodic exchanges. So that would allow a fine-tuning of your risk. And any quant, of course, would be happy if such a quantity like funding cost becomes visible. But this is at the same time a problem. I mean, if your funding cost as you as a bank becomes visible to market participants, that could be a very undesirable signal. I mean, if your funding cost is higher than the funding cost of your competitors, that could mean that you are in bad shape. and the market would react very fast. And in general, one can expect that a market-wide index would be accepted by your counterparty, whereas an individual solution, which has to be negotiated in each case, might pose problems as far as acceptance is concerned. Now we have to make model assumptions. We saw the formula. There are default times. This has to be computed by some model. There's model risk. How do you calibrate it? That's certainly an issue here. But the most serious problem, which I see, is the administrative burden and the consequent cost of that. If you have to run a self-standing legal entity, even if it's non-profit, it will certainly not do this for free. And there will be an additional administrative burden in your back office as well. And of course, as soon as you use a model here, regulators come in and they might want some backtests. They might want to see that your model really works. So summarizing this, I'm a bit skeptical, given that you might be happy with a fine-tuned funding cost management, but if you have the power to impose this on your counterparties, I'm not so sure. Now let me come to Mark's presentation. Mark discussed a little bit a different issue, namely the transition process itself. He pointed out that contracts are not prepared for the discontinuation. That's a bit surprising because, as I mentioned, more than 10 years, we know that there are problems with this rate. People assume that IBORs would be available forever. Nothing is forever. The new rates refer to a totally different economic reality, namely to the past. And this would probably end up in a value transfer. If you look at this rule book, the book which has been written by Bloomberg, as far as I know, the IBOR fallback rate adjustment rate book, I mean, the definitions there are, I'm a mathematician, I'm used to read and to write about definitions. But when I look at some of the definitions there, it's hopeless. I mean, you read them 5 times and you still do not know what they really mean. The contract terms, in particular, as Mark pointed out, day count conventions differ for different market segments that might pose serious problems, as he explained in his examples. And then at the end, who has the authority to set the standards? There is nobody. Trump is gone. Well, who can set the standards which are acceptable by the market? Can we go forward? So to summarize this, Mark's message was, it is the little things that cause big problems, or as we say in German, the devil is in the details. The Teufel steckt im Detail. Okay, let me stop here.
Thank you very much, Ernst. Because time is really short, I think we have to go to the questions of the audience. Jean-François, do you want to wrap up?
So first, there is a question by Samuel Beta on practicability of what Claudio has proposed. And it's not only for Claudio, the question, I think it's for all the speakers today. So, but maybe Claudio can start to answer.
All right, so in a nutshell, if I can first give a quick reply to Ernst. the cost of running an SPV is absolutely marginal with respect to the margin that has to be embedded into the fixed legs if we want to compensate for the risk of a funding, for the funding risk, for the lack of hedging. And also my understanding is that clients actually like the degree of transparency. I mean, if you give them a guarantee that they are not going to lose, they're not going to gain, then they will tend to trust that as long as the not-for-profit clause is demonstrable and auditable. And finally, the banks that will lack the transparency are the better runs ones. So the better banks, the bigger ones will definitely like it. The worst banks, well, we'll find that this is actually a hedge with respect to stress situations where they can go and they can end up with. So actually, it's a natural hedge to their CCAR projections, the cost and capital. But on that basis, going down to then how you technically manage to offset these wealth transfers, which is really key to what we are proposing here. One difficulty is that you need entity level modeling. I mean, so this is not really a trade by trade approach. It's an entity level approach. It means you look at the bank as a whole derivative, it's one big derivative, and then you add trades one by one to look at the impact that that trade has to projections. The projections concern both capital and collateral, so it's dual. From a technical point of view, one difficulty is scalability. I mean, a typical pricing models for derivatives have been written for one individual derivative. They're not been written for 1 million. Now, it is possible to scale up to that level, but obviously, this is something on which I've been working for 15 years. I totally know it's possible, but it's hard. The second is the sheer number of scenarios you need, because to project out capital requirements, you need massive simulation, so you have to go up to 1 billion scenarios. Now, this is like what became my specialty after I left academia. So I know it is totally possible, it is totally viable, but requires a quantum leap in the mathematics of it. Because the current mathematics that is used is totally not going to scale out. If you want to know more, if in the audience you want to know more, I'd be happy to tell you more about this. But this is really a technology problem, which in my view is totally feasible at this point in time. And there's also numerous other side effects. When you go on to entity level modeling, you have a long list of possible benefits, from stress testing to collateral allocation to capital optimization. So Libor is really a fantastic opportunity to have the mathematics and the technology make this big quantum leap, after which all other problems that we are tackling now will be reassessed, and we'll have more tools for them.
Okay, thank you. So, any thoughts about this answer? Maybe, Mark, do you want to say something?
Not specific.
Okay.
No.
Some questions to you, Mark.
Yeah, indeed. There is a very technical question at 73703.
Yeah. Let me start by the first one. So the question is, is it possible to put a price or a value or a PV01 on the different issues that are on the market risk side? I would say obviously no, but let's start by the order of magnitude. The one I've not discussed is the spread. Spreads, even if you don't look at daily basis, but at the long-term basis, I believe you can disagree with the one put by ISDA by 10 basis points, and nobody can say that you are stupid. So within 10 basis points on the long term, I would say nobody can say something. On the short term, on a daily basis, that can be 100 basis points, not the average, but when you look at the history, those spreads have moved. And then there is all the other questions where you cannot even say what will be the impact because there is no suggestion. And I will take everything related to ICE swap rates, so CMS, a lot of cash settled swaptions. There is not even a proposal how to replace it. And we are 1 year away from the end of Libor, means the end of ICE swap rates. If you don't have Libor, you don't have swaps on Libor. So if you have a CMS on sterling, 1st of January 22, you are dead. You don't even have a solution for it. So I cannot give really precise things, but there are things in all directions, and 10 basis points is not a lot. On the dates, 6 months, changing the risk 6 months by the fallback is something which happens in a lot of trades. So yeah. And I see a second question for me about the ISDA fallback. So it is too complex and introduce hidden risk, that I agree. And the other side, CCP propose, as I said, to change it, but have a cash transfer, so to pay for the spread. The problem with the CCP approach is that they are powerful. They can do whatever they want, which is not the case in the bilateral market. If I have a contract with someone, I cannot tell to that someone, do what I tell you to do, which is the power, which is bad and good, of the CCP. I don't know, I'm not a legal expert. I don't know to which extent they can do really what they want, but that's what they have said. They will change not only the rate, but the description of the trade, the payment date of the trade, which I guess they have the right to do it. But on the bilateral side, this ISDA is doing a rule. I think the rule is bad, but they need a rule where it's not one party that decides, but some kind of replacement within the definition of ISDA. So my advice there is speak to your counterparty and try to do what the CCP are trying to do on a bilateral basis. If you agree to change some payment date by 1 day or 2, but to clean all your book, that's better than have a dirty book and the same payment date. So what CCP are doing can be done. Now, what they will do, they will have value transfer, but I cannot even tell you how much, because it's value transfer with respect to what? To something that does not exist, Libor, or that will not exist. So there will be plenty of discussion about the drawback of that, but the main one is we try to move from something we don't know to something we know. And that's, you don't know what the impact of that are.
Okay. Thank you very much. I think our time is over, so, so we probably have to close it here. It remains to us, the audience, me included, to thank all the four great speakers. I think it was a very balanced debate. So thank you very much to David, Claudio, Mark, and Ernst for their very complimentary contributions. If the four of you agree, we will put your slides on the webinar webpage. And the session was recorded, so I will make the recording available as well.
Thank you, Stefan.
Okay. Thank you.
And thanks to the audience for attending. Have a very good evening, everybody.
Bye-bye.
Bye-bye.
Have a good evening.